The average American 401k balance is $167,970. The median is $44,115. That gap should stop you cold. Both numbers come from Vanguard. Same report, same year, 4.6 million accounts. Camille is 32, and she has never once looked at either number. She contributes 6% every paycheck, gets a 4% match, and feels responsible. Her statement says $91,000. She thinks that is $91,000. It is not, and that sentence is the entire reason this video exists. A 401k balance is a gross number wearing the costume of a net number. 3 separate parties get paid out of Camille's $91,000 before Camille does. The plan provider takes a cut, the IRS takes a cut, her own behavior takes a cut. Nobody at her company ever explained any of that to her. So the honest answer to whether a 401k makes you rich is uncomfortable. It depends almost entirely on subtraction most people have never been shown. Here's what actually happens between the balance and the bank account. Start with how much is riding on this for ordinary working people. 86% of eligible workers now participate in a workplace retirement plan. 25 years ago, that number was 65%. Auto-enrollment did that. For most Americans, the 401k is not one retirement account among several. It is the retirement plan. The pension is gone. Social Security replaces roughly 40%. Everything else in your old age comes out of that one account, which means every dollar of leakage is not an inconvenience. It's a subtraction from your 70s. 6% of participants took a hardship withdrawal last year. That is the highest share ever recorded. Record balances and record hardship withdrawals in the same 12 months. Now here's the part that makes this worth 30 minutes of your attention. 41% of American workers do not know they pay 401k fees at all. Not that the fees are high, that they exist. Pension B measured that in 2026. Only 33% of savers can correctly say whether they're on a vesting schedule. So 2 out of 3 people do not know if the match is theirs. And almost nobody has calculated the tax owed on their own balance. That's 3 enormous blind spots stacked on top of the single largest asset most households own. Camille is not careless. She is completely normal, and that's exactly what makes this expensive. We are going to run her actual numbers. Here's what the data shows. Camille is 32 years old and works in medical device sales in Columbus. Her salary is $78,000. She has been at the company 6 years. She contributes 6% of pay, which is $4,680 a year. Her employer matches 100% on the first 3%, 50% on the next 2. That's 4% of salary, or $3,120 a year. Combined, $7,800 goes into her 401k annually. Her balance today is $91,000. On paper, she is doing well. She is well above the median for her age, which is about $39,000. She has never changed a fund, never rebalanced, and never opened the fee disclosure. Her money sits in a target date fund, which is true for 61% of participants. That is not a criticism. Automatic beats optimal for almost everyone, almost always. Now meet Yvonne, who started the same year, at the same salary, in the same city. Let's keep this fair. Yvonne contributed the same 6% for 6 straight years. Same match, same funds, same market, same discipline. The 2 women were identical savers. Then Yvonne changed jobs in 2023, and her balance was $19,000. The paperwork gave her 3 choices, and the default box was already checked. She took the cash. 41% of Americans do exactly that at job separation. 85% of those people drain the entire account, not part of it. $19,000 became about $13,000 after federal tax and the 10% penalty. Yvonne is not reckless. She had a moving truck, a deposit, and a gap in pay. The system handed her a lump sum at the exact moment she needed one. Her new employer had a 90-day waiting period before she could enroll again. So the account was empty, the habit was broken, and nothing auto-restarted it. It took Yvonne 19 months to get back to a 6% contribution. That is not an accident. That is design meeting human nature at the worst hour. 14.8 million people change jobs each year with a 401k attached. About 4.7 million of them cash out within 12 months. Boston College's Center for Retirement Research measured what that costs across a career. Early withdrawals reduce retirement income by an average of 25%. 1/4 of the whole thing gone from decisions that felt small at the time. So Camille and Yvonne started identical, and today one has $91,000. The other has $31,000 and a story she does not tell people. She refers to it as the year she caught up, which is generous. In dollar terms, that one checked box cost her about $60,000 by 65. $19,000, left alone for 33 years at 7%, becomes roughly $180,000. She traded $180,000 future dollars for $13,000 present ones. Nobody at the exit interview said that sentence out loud to her. Most people would stop the comparison there and call Camille the winner. That is where every video on this topic stops. It is also where it gets wrong, because Camille's $91,000 is not $91,000 either. It is a number with 3 deductions still attached to it. Camille has never heard any of the 3 deductions described as deductions. She has heard the word balance 900 times and the word net 0 times. The first deduction is the one 41% of workers don't know exists. The second is the one 2/3 of workers can't answer questions about. The third is the one nobody calculates until the year they retire. Run the numbers on all 3 and the word rich stops applying so easily. Let's take them one at a time, in the order they hurt. Deduction 1, the fee nobody reads, on the statement nobody opens. A 401k fee is not a bill. No one sends you an invoice. It is subtracted from the fund's value before your balance is ever printed. That single design choice is why 41% of workers don't know it happens. The number that matters is the expense ratio, written as a percent of assets. Here's what nobody tells you about that percent. It is not a percent of your gains. It is a percent of everything every year, whether the market rose or fell. In a losing year, the fee still gets paid, in full, automatically. Plan size drives the number more than anything you personally control. Plans with more than 10,000 participants had a median expense ratio of 0.43%. Plans with fewer than 100 participants had a median of 1.29%. That is a 3 times difference determined entirely by who happens to employ you. Now watch what 1 percentage point does across a career, because this is the part. Take a worker with $25,000 saved and 35 years until retirement. At 7% returns and a 0.5% fee, she ends with $227,000. Same worker, same returns, same contributions, but a 1.5% fee instead. She ends with $163,000, $64,000 gone. That is a 28% reduction from a number that looked like 1%. Most people hear 1% and think 1%. The math does not work that way. The fee compounds against you at the same rate your money compounds for you. Every dollar taken in year 3 cannot earn for the following 32 years. Demos ran this across a full 2-earner household at median income. They're finding $154,794 in fees and lost returns. That is a house down payment extracted quietly over 40 years without a single invoice. Camille's plan charges 0.87%. She has never seen that number. On $91,000, that is $792 this year alone. Not a catastrophe, but it is the first thing standing between balance and reality. Deduction 2, the match, which most people describe with 2 wrong words. Free money. It is neither free nor, in many cases, money you own. Start with free. The average employer match reached 4.7% of pay. Economists have argued for decades that match dollars are funded out of wages. It is compensation routed through a different pipe with strings the wage pipe doesn't have. Now start with money you own. That depends entirely on your vesting schedule. Federal rules allow cliff vesting up to 3 years and graded vesting up to 6. Graded typically means 20% after 2 years, 60% after 4, 100% after 6. Leave in year 3 of a graded schedule and you forfeit a large slice. It goes into your employer's forfeiture account, which is exactly what it sounds like. Only 33% of savers can correctly state whether they are on a schedule. So 2/3 of American workers cannot answer a question that decides thousands of dollars. PensionBee calculated that outdated vesting rules can cost a single saver over $61,000. Then there's the other direction, which is the more common failure. 25% of workplace savers do not contribute enough to earn the full match. 8 in 10 plans require between 4 and 7% to unlock the maximum. The median required deferral is 6%. Contribute 5 and you leave money behind. Here's what that costs. Take a worker earning $2,569 of match yearly. Starting at 30, at 7% returns, that match alone becomes $355,000. By 65, from the employer's contribution only before counting a dollar of her own. Most people leave that on the table because the enrollment default was 3%. The default is not advice. The default is a number someone picked for the plan. Deduction 3, and this is the one that changes the answer to the question. A traditional 401k balance has never been taxed, not once, not partially, which means the IRS is a co-owner of that number at a rate not yet set. Most people believe they deferred taxes. What they actually did was defer the rate decision. You know the deduction you took, you do not know the rate you'll pay. Camille's $91,000 is not $91,000 of spendable money. At a 22% effective rate in retirement, it is about $71,000. At 24%, $69,000. At 32%, $62,000. The statement will never show her any of those three numbers. Scale it up and the effect stops being academic very quickly. Fidelity counted 645,000 401k millionaires in the first quarter of 2026, down 3% from 665,000 the previous quarter on market movement alone. Every one of those traditional account millionaires owns less than $1 million. A $1 million traditional balance taxed at an effective 22% is $780,000. The word millionaire is doing a lot of unearned work in that headline. Then required minimum distributions arrive at 73, whether you want the money or not. You do not get to decide the timing, the IRS decides the timing. That matters because the timing is what triggers the thing nobody plans for. Roth 401k balances stopped being subject to those distributions in 2024, which is a quiet, enormous difference that almost no enrollment packet explains. And starting in 2026, catch-up contributions must be Roth above $150,000 in wages. Congress moved that lever on purpose. Deferred taxes are a receivable on a government balance sheet. Now, the part almost every video on this topic gets backwards. People obsess over fund selection. Fund selection is the third most important variable. The first is contribution rate. The second is whether the money stays in the account. Vanguard's 25 years of data make this almost embarrassingly clear. The average employee deferral last year was 7.6% of pay. With employer contributions, the average total rate reached 12.1%. Participation rose from 65% to 86% over that same period. Almost none of that improvement came from workers getting smarter about investing. It came from plan design, auto-enrollment, auto-escalation, and default target date funds. 45% of participants raised their deferral last year. Only 14% chose to. 31% were escalated automatically without lifting a finger or making a decision. That is the actual engine, not stock picking, not timing, not any of it. Which means the highest leverage move available to Camille is boring and unglamorous. Raise the contribution rate by 1% and let plan design do the rest. On $78,000, 1% is $780 a year, roughly $15 a week, which is a lunch she'd forget by Thursday. Over 33 years at 7%, that $15 becomes about $111,000. Most people believe the path to a bigger balance runs through better funds. It runs through a slider on a website that takes 11 seconds to move. The 2026 limit is $24,500 for employee contributions. $8,000 more at 50 and $11,250 between 60 and 63. Almost nobody hits those ceilings. Almost everybody could move 1%. So let's answer the actual question with actual arithmetic instead of vibes. Rich is not a balance. Rich is an income you never have to earn again. Use 4% as the annual withdrawal rate, which is the common planning anchor. Take the median balance, $44,115. At 4%, that produces $1,765 a year. $147 a month. That is a phone bill, not a retirement. The average balance of $167,970 does better. $6,719 a year, $560 a month, before tax, so call it $437 of actual spending money. That is not rich. That is a supplement to Social Security and nothing more. Camille's $91,000 at 4% is $3,640 a year. Now project her forward because she is 32 and has 3 decades of compounding. $7,800 a year, 33 years, 7% on $91,000 today. She arrives at roughly $1,700,000 at 65. That is a very good outcome. It is also not $1,700,000. Subtract her 0.87% fee drag across those 33 years. Call it about $350,000 of compounded fee cost, conservatively. Then subtract the IRS's share at an effective rate of roughly 22%. She lands near $1,100,000 of actual spendable money. $44,000 a year at 4%, $3,660 monthly. That is a good, stable, dignified retirement. It is not a private jet. And that outcome requires 33 uninterrupted years of not being Yvonne. Which brings us to the deduction that isn't in any disclosure document. 6% of participants took a hardship withdrawal last year. Record high. Hardship withdrawals rose in the same year that balances hit record levels. Both things are true. Both things describe the same fragile household. Most people think of a 401k as untouchable. The plan documents disagree. There are loans, hardship provisions, and a cash-out button at every job change. 60% of accrued assets leak out of the system across job transitions. 60%, not of accounts, of dollars measured across the whole system. For balances under $1,000, the cash-out rate reaches 80%. It falls below 30% only once balances pass $15,000 to $25,000. Which tells you something uncomfortable about how the first years actually work. The account has to survive long enough to become psychologically real to you. Under $1,000, it feels like a rounding error, so it gets spent. At $25,000, it feels like a thing, so it gets protected. Nothing about the underlying math changed, only the story the owner tells herself. Here's what actually protects a 401k, and it isn't discipline or willpower. It's friction. A rollover form that takes an hour is a feature, not a bug. Yvonne's cash-out took 4 minutes. Her rollover would have taken 45. That $60,000 gap in outcomes came from a 41-minute difference. Design beats intention. Every single time, for everyone, including people who know better. One more layer, and this one is entirely outside your control. Your 401k quality is determined by an employer who is not optimizing for you. The plan sponsor picks the provider, the fund menu, and the fee structure. You get a menu. You do not get to write the menu. A worker at a 10,000-person company and a worker at a 40-person company are not equal. Same salary, same contribution rate, same discipline, 3 times the fee load. Over 35 years, that is the $64,000 gap we calculated earlier. Nobody negotiates it. Nobody mentions it in the interview. It never appears in the offer letter. Most people compare job offers on salary, title, and paid time off. Almost nobody asks for the fee disclosure or the vesting schedule before signing. Those 2 documents can be worth more than a $5,000 salary difference. And in 2026, some companies began pausing employer matches entirely. A match is a benefit, not a right. It can be reduced or suspended, which means the 4.7% average is a snapshot, not a guarantee. Here's what nobody tells you about the 401k as a system. It is a defined contribution plan, which means the risk transferred to you. Pensions put investment risk, longevity risk, and market timing risk on the employer. The 401k moved all 3 onto a medical device sales rep in Columbus. Camille did not agree to that transfer. Nobody asked her. It was already done. So the question isn't whether the 401k is good, it's what it replaced. Let's look at what this changes for someone at the beginning instead of the middle. Priya is 28, earns $62,000, and just got auto-enrolled at 3%. 3% is $1,860 a year of her money. Her plan matches 50% of her contributions, up to 6% of pay. So at the default 3%, she is capturing exactly half the match available. Moving from 3 to 6% costs her $1,860 annually. Pre-tax, in the 22% bracket, her take-home pay drops about $1,450. That's about $120 a month out of her actual paycheck. In exchange, her account receives $3,720 of her own money, plus $1,860 of match, up from $930. Across 37 years at 7%, that single slider move is worth about $440,000. She will never make a better financial decision than the one taking 11 seconds. And she will almost certainly not make it because nobody will ever tell her. The enrollment email said, "Congratulations, you're enrolled." It did not say you're leaving money. That's the whole failure. Not greed, not stupidity, just an information gap nobody profits from closing. Now here's the counterintuitive part, and almost nobody on YouTube has surfaced it. You have been told the 401k deduction works because your retirement rate will be lower. Contribute at 22% today, withdraw at 12% later, keep the difference. For a large group of middle-income Americans, that is precisely backwards. Not slightly wrong, backwards. And the mechanism has a name almost no one uses. It is called the Social Security tax torpedo, and it works like this. Your Social Security benefit is not automatically taxable. It depends on provisional income. Provisional income includes your 401k withdrawals, which means withdrawals do two things at once. They get taxed themselves, and they drag your Social Security benefit into taxation. Inside the phase-in range, each extra dollar withdrawn makes up to 85 cents taxable. For couples with provisional income between $32,000 and $44,000, $1 adds $1.50. $1 of withdrawal creating $1.50 of taxable income. Read that again. The Financial Planning Association measured the resulting effective federal marginal rate, 40.7%, federal alone, for a middle-income retiree, not a wealthy one. With long-term capital gains or qualified dividends in the mix, 49.95. Nearly 50% on a household that never saw a 50% bracket while working. Here's the quotable version. The deduction was never a discount. It was a loan. And the interest rate on that loan is set decades later by strangers. The thresholds make it worse in a way that is almost hard to believe. $25,000 for individuals, $32,000 for couples, set in 1984. Never indexed for inflation, not once, in more than 40 years. Every year of inflation pulls more ordinary retirees into a bracket built for the wealthy. Russell retired at 68 with $840,000 in a traditional 401k. He deferred at 22% for 31 years and felt clever about it. At 73, required distributions began. He did not choose the amount or the timing. His effective marginal rate on the last chunk of that distribution was 40.7%. He saved 22 cents on the dollar going in and paid 40 on the way out. This is not a loophole or a scandal. It is arithmetic nobody showed him at 35. And it is the single strongest argument for splitting contributions between traditional and Roth. Not because Roth is better, because tax diversification is the only hedge against a rate you can't see. Roth 401k balances also escape required distributions entirely, which diffuses the torpedo before it arms. So, is your 401k actually making you rich? Here is the honest answer. For almost everyone, no. It is making you solvent, which is a different word. The median balance funds $147 a month. That is the reality. But for a specific kind of saver, it does something close to rich. That saver does 4 things, and none of them involve picking a single fund. She contributes enough to capture the entire match because the median threshold is 6%. She knows her expense ratio because 0.43 and 1.29 are different lives. She never cashes out at a job change because 41% of people do. And she splits between traditional and Roth because the rate on the loan is unknown. That's it. That is the entire list. No fund picking, no timing, no genius required. Camille moved from 6% to 8% this spring after reading her fee disclosure. Yvonne rolled over instead of cashing out at her last job change. It took 40 minutes. Priya moved the slider from 3 to 6. She spent 11 seconds on it. None of them became rich this year. All 3 changed the ending. If this was useful, subscribe to Coach Nora Money and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. No hustle culture, no shame, and no product at the end of the video. Your 401k balance is not a score, it is a gross number. Learn what's subtracted from it, and you will make better decisions than 90% of savers. Make the decision that matches your reality, not someone else's sales pitch.